Last week, a majority of the largest investment banks here in the US reported their quarterly earnings. And on their earnings calls, there was two resounding themes. One, they all expect the unemployment rate to be around 20% or even higher, which is numbers that we have not seen since the Great Depression. And the second thing is all of the banks are going to be increasing their loan loss provisions, fearing that both individuals and businesses are going to continue to struggle to pay their bills. Even with that news, the Nasdaq continued to rally and is now down only 3.5% for the year. So it's starting to become clear that there's a disconnect between the market and what's going on with the economy. In this week's video, Jared's going to be covering the returns, our wealth management advisor Michael Tedeschi is going to be covering oil and the Nasdaq, and I'm going to be covering the three major news stories that moved the markets. As always, if you enjoy this content, make sure you subscribe to our channel and follow us on Facebook.
Last week, the U.S. markets continued their push higher for the most part, as the S&P 500, the Dow Jones, and the Nasdaq were all positive. The S&P was up about 3%, while the Dow Jones was up just over 2%. The Nasdaq had a great week, as the technology sector was up over 6%. Most of these gains through the S&P 500, the Dow, and the Nasdaq happened on Friday. So it was a relatively quiet week up until then. But for the Russell 2000, we saw another red week. So that was a little bit of an outlier out of the U.S. markets last week. And now the Russell 2000, which consists of the smaller companies, small and mid-cap stocks, year to date down 26%. And if you're seeing here on this sheet, the Nasdaq, which had a strong week, the tech sector was only down about 4% year to date now, with the Dow and the S&P right in the middle, with the S&P down 11% for the year. Dow Jones is down 15% for the year. So out of the U.S. market, there's a big disparity between the S&P 500 and the Dow, which are those large cap companies, down again about 10 to 15%. Nasdaq almost even for the year, but the Russell 2000 small caps lagging big time, still down almost 30%. Now, foreign and emerging markets were also both positive last week, with emerging markets leading the way. They were up about 2.5%. Now, both foreign and emerging markets are down right around 20% for the year.
Morning, everybody. Mike Tedeschi, Wealth Management Advisor over at Perspective Wealth Planning, with this week's key charts for you guys. We're going to be taking a look first at crude oil. We took a look at this chart last week. This is a chart going all the way back to 1983. So we're looking at a monthly candles going back 4 decades here in this chart. We have not traded under that $9.75 level in the last 40 years. And in the last 20 years, that key low that we were watching was around that $17 level, and that's this upper white line that's on the chart here. Over the weekend, it became very apparent that short-term oil storage was completely at capacity, and that has sent the May contract for delivery down to the lowest level that we've seen in over 20 years at $11.04 was as low as this contract traded here on Monday morning, down almost 40% from Friday's close. This is a huge occurrence, and this has major implications for the overall economy because oil is a key component of the global economy. And this is something we continue to pay very, very close attention to because it will have profound implications for markets moving forward. Now, the next thing I want to take a look at is the Nasdaq Composite Index, which is a sum total of all the components inside of the Nasdaq. As Matt said, this is traded down for the year so far about 3.5%. This white line is where we closed last year. So that would be the area that we need to get above in order to be green for the year. What's very interesting to note is that the Nasdaq 100, which is the top 100 companies in the Nasdaq, is actually green for the year. It's up. As you can see, this white line on the screen here is where we closed last year, so it is up. What this is telling us is that the bigger companies are performing stronger than the index as a whole, and in fact, we have a way to actually visually represent this as we take a look at the S&P 500. Now, what we have on the screen here is the S&P 500 is the chart on the top, and the chart on the bottom is the S&P 500 equal weight divided by the S&P 500 market cap weight ratio. And what that means is the equal weight is every company in the index is considered the same, whereas the market cap ratio index, the bigger companies make up a bigger part of the index. And what we can see is that the bigger companies are leading the charge higher. They are making up the lion's share of the game. Wealth is really being concentrated at the top of the companies in the indexes. In fact, the 5 most valuable companies in the world make up a larger percentage of the stock market than they ever have in history. The only other time we saw numbers this high was back in the dot-com bubble. So these are some things to definitely pay attention to as we move forward. The behemoths continue to get bigger while the rest of the index continues to struggle, as we can see here from this chart. Have a great week.
The first news story that I wanted to cover was just a little more detail on what the banks said last week. Now, these banks are also 5 of the largest lenders in the US, and they've increased their loan loss provisions by about $24 billion. So to put that into perspective, that's 5 times more than they normally keep on hand. And they've cited that people really haven't been paying their bills since the beginning of March. And as the country continues to be closed and businesses remain closed for the weeks ahead, things could get even worse. And it's extremely important for these banks to keep these extra loan loss provisions on hand to make sure that their credit quality doesn't suffer. The second news story that I wanted to cover was the announcement last week that the PPP loan program ran out of funds. And President Trump ordered Congress to get back to work to refund this program. What this program was set up to do is help businesses during this shutdown keep employees on the books and also just have enough operating capital to keep running. It seems like this loan program is extremely flawed, and I personally know many businesses that haven't even had their loan applications reviewed, let alone having the bank call them about funding. So if we don't see something happen with the PPP loan program, we could be looking at an unemployment rate that is closer to 30%, not just 20%. The last news story that I wanted to cover was the debate that's going to be going on over the next couple weeks about reopening the country and the economy. Now, President Trump has put this back onto the governors, telling them that they need to figure out how to reopen the economy. But he said if things are going too slow, that he has the power to reopen the economy everywhere around the country. So now we have a debate between federal and state, and also a debate that really cannot be won, because either way, people are going to suffer. On one hand, you'll have extreme unemployment. On the other hand, if we do reopen the country, there will be an increased caseload of the coronavirus. As always, thanks for watching. And this week we're going to be watching earnings season as we're getting into the heart of it, what's going on with oil, and how low the price actually will drop. And lastly, the Fed has entered their dark period, the 2 weeks prior to their April 28th meeting. So rumors are going to begin to swirl as to what the Fed is going to do at that meeting, but the Fed actually can't come out and say anything that they're discussing at this time.